The purpose of this lecture is to give you a background on the existing standards for accounting and financial reporting for pensions and other post-employment benefits by state and local governments. It's expected that by the time you have finished viewing this presentation that you'll have a good sense of what is required by GASB Statement 45 on other post-employment benefits, or OPEB, as well as the requirements of the new standards for pensions as set forth in GASB Statement 68, and also to understand why the GASB has changed the standards for accounting for post-employment benefits in general by issuing these new standards on pensions and by proposing last year new standards for OPEB that would apply the same new approach to accounting and financial reporting. So beginning with OPEB, as set forth by GASB Statement 45, and what I'm talking about here are the standards for reporting by employer governments, reporting on the obligations and costs associated with providing OPEB to their employees, as opposed to the separate standards on reporting by plans themselves. In the case of OPEB plans, that would be GASB Statement 43. So we're looking here at how a city or a state or a school district would report on the cost of benefits that it promises to its own employees. By post-employment benefits in general, we're talking about all of the benefits that are provided after someone has retired or otherwise left the employment of the government. It's a part of the total compensation for the services that the employee provides to the government, in addition to the salary and other benefits that they receive while they're working for the government. OPEB refers to everything other than pensions. So we're talking primarily here about health care benefits, health insurance for retirees, but it also includes other types of benefits like life insurance that is not provided through a pension plan. It's important to understand how the GASB views the transaction between the government and its employees that results in this promise to provide OPEB as well as to provide pensions. As I mentioned, the GASB views this as a part of the compensation for service. It just is compensation that is deferred until after someone has retired. It is an exchange transaction between the government and the employee. The employee provides services, works for the government, and the government in turn provides a salary and other benefits, and then pension and OPEB. So these benefits are earned by the employee during his or her employment, and the GASB views the transaction not as a new transaction each year. This year the employee works and receives compensation. Next year the employee works and receives compensation. But rather, the transaction that results in the provision of post-employment benefits is one that extends over the lifetime of the person's employment. And so that results in some differences in the way that GASB requires governments to account for pensions and OPEB from the way that FASB requires publicly traded companies and not-for-profits and other non-governmental entities to account for pensions and OPEB, because those standards are more or less looking at this as a new transaction every year, whereas the GASB thinks about it as a transaction over what tends to be the relatively long service period of government employees, because government employees do tend to work for their employer for an extended period of time, longer on average than people who work for private sector companies do. The approach that GASB takes to post-employment benefit accounting is the same regardless of whether it's pensions or OPEB, that's because GASB believes that these are the same kind of transaction, even though the precise benefit is somewhat different, and therefore a single approach to accounting and financial reporting should be taken for all benefits regardless of what type they are. And that's why when Statement 45 on OPEB was issued in 2004, it largely mirrored what was required at that time for pensions under GASB Statement 27. And that is why After GASB issued these new pension standards, Statement 68, in June of 2012, the board began to consider how to apply those standards to OPEB as well. And so in June of 2014, GASB issued an exposure draft proposing those same changes to OPEB so that OPEB would be consistent with pensions, and it is expected that final statements on OPEB will be issued in June of 2015. Before we proceed, let's make sure that we all understand precisely what we're talking about. Predominantly what we're talking about here is accounting for defined benefit pensions and OPEB. That is, a pension or OPEB plan in which the amount of the benefit that the employee will receive in the future is specified, and the government then, particularly with pensions, not as much with OPEB, is making contributions to a trust in advance to ensure that sufficient amount of money is in place when that person retires and starts to receive benefits. So the idea here is this promise has been made now, and the promise is that in the future I'm going to provide you a certain amount of benefit, which means the government has a liability for this right now. As opposed to a defined contribution plan in which what is specified is not the amount of benefit, but the amount that the government is going to contribute to an employee's individual account, similar to a 401k. So if there's any liability here at all, it's for a payment that was supposed to be made to an employee's account but hasn't been made yet. There's no broader liability for future benefits the way there is under a defined benefit plan. There are essentially three types of plans, and it's important to understand the differences because the accounting standards apply somewhat differently. Under the old pension standards, under the existing OPEB standards, Statement 45, there are some pretty significant differences in the accounting requirements depending upon the type of plan. Statement 68 on pensions and the new OPEB standards that will come out in 2015 eliminate a lot of those differences so that how the accounting and reporting is done is much more similar regardless of the type of plan you're in. But the three types of plan are single employer plans, that is a plan that includes just one government, agent multiple employer plan, so this is a plan that has two or more governments, usually many governments, and they make contributions to this plan, and those contributions may be pooled for investment purposes because it will generate a greater return than any of the individual governments could have generated. But separate accounts are kept for each government so that benefit payments to that government's employees are only made out of that government's account. That's different from a cost-sharing multiple employer plan in which the contributions from the participating governments and from their employees are not only pooled for investment purposes, but all of the benefits are paid out of that common pool of assets. The actuarial valuation, the measurement of the pension liability or the OPEB liability is done for the entire plan as a whole, whereas under an agent multiple employer plan, actuarial valuations are done for each individual employer so that that employer knows how much to contribute to their account. Under the old standards, it was the cost-sharing employers that had less of an accounting and financial reporting burden because that actuarial valuation was done for the plan as a whole, and so a lot of the information about the funded status of the plan was not available for the individual participating employers. Under GASB Statement 68 for pensions, a lot of that lesser reporting has been eliminated so that cost-sharing employers have to report pretty much the same thing that other types of employers do as well. The measurement of the OPEB liability, what takes place in the actuarial valuation, can be summarized in three steps. And if any of you are an actuary, I apologize for having boiled down what is a fairly complex science to a rather simplistic list of three steps, which is to project future cash outflows for benefit payments, to discount those projected benefit payments to their present value, and then to allocate that present value to periods of employment service, both past and future, using an acceptable actuarial cost method. And the standards for both pensions and OPEB, basically establish the assumptions and methods that can be used in each of these three steps. So if you look at this visually, when you're doing the actuarial valuation, you know how old the employees were when they were hired, and you know how old they are now. And the difference between that is the period of service over which they've already worked and have been earning benefits. And then you're going to make some assumptions about how old they will be when they retire, and this and all other assumptions are based upon the covered membership of the plan. So it's historically verifiable information based upon the people who were actually covered by the plan. So that period from when they were hired to when you believe they're going to retire or otherwise leave the employment of the government, that's their service period. That's the period over which this transaction is taking place when the employee is earning these benefits. An assumption's also going to be made about life expectancy, when people are expected to die, and the difference then between the assumption about when they retire and when they pass away tells you the period over which they're going to receive benefits, and that's the period for which you're going to project benefit payments based upon the terms of the pension or OPEB plan. So you're projecting these benefits for the year that they retire, and then the following year, and the following year, and the following year. In this case, 18 years. In this example, you're going to project what their benefit payments are going to be. And so you know how much the benefit payments are right now. Let's say the cost of their OPEB is $4,500 now, and based upon a variety of assumptions, most notably for OPEB, the healthcare inflation rate, which tells you how much the cost of health insurance is going to rise each year going forward, you're going to project out how much it's going to cost to provide these benefits to this employee in each of those future years during the period when they're receiving benefits. Each of those projected benefit payments is then discounted back to their actuarial present value, their value in today's dollars. And that actuarial present value is then attributed to past periods of service as well as to future periods of service. And that is done using an acceptable actuarial cost method. And it is this portion of the actuarial present value that is allocated to past periods of service. So if you look at this section over here, right here, the portion of the APV that was allocated to these past years, that's the amount that serves as the basis for reporting the obligation for OPEB or for pensions. It's the basis for what is reported as the pension liability or the OPEB liability. These actuarial valuations for OPEB are supposed to be done at least every other year. The standards encourage that they be done annually rather than biennially. If a government has a plan with fewer than 200 total members, meaning not just the active employees, but all of the people who are no longer working for the government, who are eligible or are actually already receiving benefits, if it's smaller than 200 members, then they can use, instead of an actuarial valuation, something that is called the alternative measurement method. And that is essentially, I won't say simplified because it's still not simple, but it does simplify some of the assumptions and techniques with the idea that a non-actuary, somebody working for the government, might be able to actually do this themselves rather than hire an actuary to do it. I think in practice what happens a lot is that they still hire an actuary, but to do the alternative measurement method, and that's less expensive than doing a full actuarial valuation. The reason this method exists is a cost-benefit concern. Standards are required to produce a benefit that exceeds the cost of applying the standards, and in this case, the board felt that there might be some loss of accuracy using the alternative measurement method, but in order to make it easier, make it possible in some circumstances for a smaller government to be able to apply the standards, that loss of accuracy or reliability was justified by the reduction in the cost. So the usefulness might be a little bit less because it might not be as accurate as a full valuation, but the savings in terms of cost to those governments, more than substantiated that trade-off. The projection of benefit payments, in addition to making some assumptions about relevant factors that determine how much those payments are going to be and when they're going to be made, is ultimately based on what for OPEB is referred to as the substantive plan, meaning the actual benefits that are understood by the government employer and by the members of the plan. Now, when you're talking about pensions, the details of how the pension benefit payments are going to be calculated are usually written down in great detail, but that's not always the case for OPEB. In a lot of cases, OPEB has just traditionally been provided to the employees, but has never actually been written down in a labor contract, or in some other official document. And so it was important when these standards for OPEB were issued to make clear that these provisions for benefit payments didn't have to be written down, so that governments could say, well, this isn't part of any agreement with them. We don't have a liability. The board very strictly said here, well, no, if you're providing these benefits and it's understood that that's a part of your compensation to the employees, then you do have a liability. And you need to project based upon what everyone understands the benefits to be. Now, that projection may include a benefit cap, meaning some provision that says the government, that the benefits are limited to a certain amount. Maybe the employees can't receive health benefits that exceed $10,000 a year, because that certainly would limit how much the government is on the hook for if the benefits aren't unlimited, but are capped at a certain level. On the other hand, a cap on contributions from the government, is not considered, because the fact that a government is limited to only contributing a certain amount doesn't change the cost of the benefit. The cost of the benefit is what it is, regardless of who's paying for it. One thing that is unique to OPEB is this thing that is sometimes called the implicit rate subsidy. The projection of the cost of OPEB is usually based upon claims costs, so the cost of actual insurance claims, or what is known as age-adjusted premiums, which approximate claims costs based upon the age of the people who are in the insured group. And so one thing you have with OPEB, particularly talking about retiree health insurance, is that in a lot of cases the retirees are insured separately from the current employees, but in a lot of cases they're insured together, and so the premiums that are paid, take into account the fact that there are a lot of older people in the plan, and that usually makes the average premium much higher, because as you should know, the older you get, the more expensive your health insurance gets, because your claims are greater. You're much more likely to use healthcare services when you're older than you are when you're younger. So what happens here is that there are cases where a government may not actually make any cash contribution on behalf of the retired employees. They're not paying for the retired employees' premiums, but they do allow the retired employees to be insured in the same pool as the current employees. And what that does is it lowers the premiums that the retired employees otherwise would pay. That's a real benefit to them. But at the same time, it increases what the government has to pay for its current employees. And the difference between what it otherwise would have paid for those current employees if they were separately insured from the retirees and what the government is actually paying for them, that difference is the cost to the government of the OPEB for the retirees. So, as you can see, I more or less prefaced this already. They allow the retirees to continue to participate in this plan in which the current employees are insured, which makes the premiums lower, because these people, these younger employees who are still working and don't use as much service, cost less to the insurance company. So here's an example. Let's say the age-adjusted premium in this insurance pool in which they've got both the retirees and the current employees is $6,000 per retiree. But the retiree is paying this blended premium of $3,600. So, essentially the contribution of the employer, even though the employer isn't actually making a cash payment, is the difference between what it would have cost for the retiree to insure themselves, the $6,000, with what they actually have to pay, which is $3,600. The government is subsidizing that $2,400 difference. So even though the government isn't making a cash payment to the retiree or on behalf of the retiree, the government is making a cash outlay in the form of higher premiums for their current employees than they would have had to make otherwise. So that covers the projection of OPEB benefit payments. The second step then is to discount those projected benefit payments to their actuarial present value. And to do that, an assumption has to be made about a discount rate. And for OPEB, that discount rate is a weighted average of the long-term expected rate of return on the OPEB plan's investments and the return on the employer's general investments, a return that usually is far lower than what you'd expect from the long-term investments of a pension or OPEB plan. The way you determine the weighting is usually done in one of two ways. It might be done based upon the degree to which the OPEB plan is funded. So if it has assets that are equal to 1/3 of the OPEB liability, it's 33% funded, so you'd multiply the long-term expected rate of return by 1/3, the government's general investment return by 2/3, and that weighted average would be then 4.5%. That's the discount rate that would be used to discount those projected OPEB benefit payments. This is not used that often because very few OPEB plans have any assets in them at all. Most governments finance their OPEB on a pay-as-you-go basis, meaning there's a bill for the insurance premiums, and they make that payment when the bill comes in, rather than setting money aside in a trust the way that they do for pensions. So what you more often see is a weighted average based upon a comparison of their contribution amount for the year with the annual required contribution, and I will say more about what that is, the ARC, in a little bit. But if their contribution is 50% of the ARC, then they'd multiply each of the two rates by 50%, add them together, and you have a weighted average, in this case, of 5.25%. It's important to note that each of those projected benefit payments, in that example we looked at from age 62 through age 80, each of them is going to be discounted using the 4.5 or the 5.25% that you came up with in this weighted average. And I mention that so that when we get to talking about Statement 68 on pensions and the way that discounting is done under those standards, when I say that it's different there, you'll understand why. So now you have the actuarial present value, those projected benefit payments in today's dollars, and a government then uses one of 6 allowable actuarial cost methods to allocate some of that present value to past periods of service and some of it to future periods of service. And that may be done on an open or closed basis as a level dollar amount or a level percentage of covered payroll. A level dollar amount means essentially, spreading it in equal amounts every year like a mortgage. Whereas a level percentage of covered payroll, the amounts grow over time, as the amount of payroll grows. So it's, say it's 10% of payroll, and so payroll is going to rise, and the amount that is equal to 10% of payroll is going to grow over time as well. That amortization period is limited to no more than 30 years. So the result of this actuarial valuation are three key measures of the OPEB obligation. The first is the actuarial accrued liability. If you subtract from that the actuarial value of assets, that equals the unfunded actuarial accrued liability. The AAL is the amount I referred to before, the part of the present value that's attributed to past periods of service. That's the total obligation for OPEB. The actuarial value of assets is a measure of the value of the assets in the OPEB plan. It's not the fair value as of the date of the financial statements, but rather a smoothed value, meaning that the annual changes in the value of the assets are introduced into actuarial value of assets usually over a 3 to 5 year period. And that was done in order to help minimize volatility in the changes of the value of assets. And then the UAAL, the difference between the AAL and the AVA, is what is commonly known as the unfunded liability. This is the portion of the total obligation for OPEB that isn't covered by assets set aside in the plan. And in the case of OPEB, it's not unusual for the UAAL and the AAL to be exactly the same number because there are no assets set aside in a plan. When you're looking at pensions, the AAL is larger because virtually every pension plan has some money set aside, and so the unfunded liability is just a percentage of the overall liability, the AAL, because you have assets in the plan that have been set aside and invested for the purpose of paying those benefit payments when they come due in the future. In terms of financial reporting of this information, the AAL, the AVA, and the UAAL are disclosed in the notes, and they're also presented over time in required supplementary information schedules. They're not recognized on the face of the financial statements. To the extent that there is a liability related to OPEB in the financial statements, it's something called a net OPEB obligation. And what that is essentially the accumulated under contribution to the OPEB plan. So that annual required contribution I mentioned before, and which I will describe more fully shortly, if they contribute less than that, the difference is reported as a liability on the face of the financial statements, this net OPEB obligation. So what you're seeing there, if you see one, and for most governments you will, because as I said before, they don't contribute the ARC, they go on a pay-as-you-go basis, and pay-as-you-go payments are usually a lot less than what would be required as an annual required contribution. That's the cumulative underpayment since the government implemented Statement 45. I don't know that I've ever seen a net OPEB asset, but theoretically it's possible that if a government over time has contributed more than the ARC cumulatively, it would have a net OPEB asset. You may occasionally, under the old pension standards, see a net pension asset, but I have never seen a net OPEB asset because virtually every government finances OPEB on a pay-as-you-go basis. So as I promised, here's this thing called the ARC. And this is the basis for reporting the cost, the annual cost of OPEB benefits in the financial statements. It is theoretically an amount that if a government contributed it every year, there would be sufficient resources in the plan in the future to make all benefit payments. That doesn't always work out in reality because some of the assumptions that go into the ARC. But essentially the ARC has two pieces, based upon this notion that this would fully fund the benefit payments over time. A portion of the ARC is the normal cost or the service cost, which is the cost of the benefits newly earned in that year. And then the other portion of the ARC is an amortization of the unfunded liability. Let's say they assume, they amortize over 30 years. In simple terms, you're saying 1/30th of the unfunded liability plus the normal cost for the period. That's your ARC. And if you were to contribute that each year, you'd eventually, get to full funding or stay close enough to it that you'd always have sufficient resources in the plan to make the benefit payments when they come due. The actual amount that is reported as OPEB expense is based upon what is called the annual OPEB cost. Now, if a government were funding the ARC, paying the ARC every year like many do for pensions, then the expense would be equal to the ARC. And if they had a net pension obligation, meaning they were under contributing, then an adjustment would be made to the ARC to create what is called the annual pension cost, and that would be the number reported as pension expense. For OPEB, because very few, if any, governments are contributing the ARC, and so they're all reporting net OPEB obligations, the OPEB ARC is almost always being adjusted to create the annual OPEB cost, and it's the annual OPEB cost that is reported as OPEB expense in the accrual-based financial statements. So it starts with the ARC and then makes some adjustments to it to create the annual OPEB cost, and then that amount is reported as expense. What's important to understand here is what gets counted as a contribution by the employer. In the case of pensions, that's almost always the contribution made to the pension plan, although some pension benefits may be made directly to the employees by the government, in which case that would get counted as a contribution as well. For OPEB, you're mostly then talking about either the direct payments of health benefits to the retiree or the payment of insurance premiums. Both of those would count as contributions. And if they are, in fact, making a contribution to an irrevocable trust, that would count as a contribution as well. So here's an illustration of how this works. You have your normal cost, which is $350,000. So that's the cost of benefits newly earned this year in return for employment, providing services by the employees. An amortization of the unfunded liability. So, we'll assume that's the roughly 1/30th of the unfunded liability. You add those two together, and that's your ARC. There's interest on the beginning net OPEB obligation. It's a liability. It accrues interest like other liabilities. But when a new valuation is done, each year or every other year, it takes into account the fact that that full contributions or the full ARC wasn't contributed to the plan. And in order to avoid double counting, an adjustment needs to be made to the ARC. And you can see that adjustment here is $58,500. I'm not going to get into any more technical detail about it because you don't really need to understand it for these purposes. And it's a little bit more complex than I'm describing. But what you have left then is the annual OPEB cost, which in this case is $941,500. And that is the expense that is reported in the accrual-based financial statements as the OPEB expense. Let's assume this government is a pay-as-you-go government, and its contributions were the payment of insurance premiums, which totaled $250,000. So the difference between the annual OPEB cost and the employer contributions is the amount by which the net OPEB obligation would increase on the face of the financial statements. And so in this example, at the beginning of the period, they had a net OPEB obligation of $650,000. That's going to increase by the difference between the annual OPEB cost and the actual employer contributions of $691,500. So at the end of the period, what is reported in the financial statements as the net OPEB obligation is $1,341,000. Governments are expected to disclose information about the funded status and the progress on funding of the OPEB plan. And so they will disclose the AAL, AVA, and UAAL, as well as some ratios of those information that give you a sense of the proportion or the magnitude of the liability or the obligation that the government is facing. So here's an example. We have a government that has an AAL of $13.5 million. It doesn't have any assets set aside in the plan, so the unfunded liability is exactly the same, $13.5 million. The funded ratio is the AVA divided by the AAL. And in this case, there is no AVA, so the funded ratio is 0. It's completely unfunded. The antithesis is 100%, fully funded. And in some cases, governments might have an actuarial value of plan assets that's greater than the AAL, and so their funded ratio would be greater than 100%. You might see that occasionally in pensions. You never see it in OPEB. 0% is usually what you see. Covered payroll is the annual payroll for the active members of the plan, and you divide the UAAL, the unfunded liability, by the covered payroll to get this ratio at the bottom, 177.6%. And the point of this is to give you a sense of how big a deal it is. Something that you can actually compare with other governments. If you look at two different governments and they both have an unfunded OPEB liability of $13.5 million, does that mean that they both, have, a liability of the same magnitude? It only means that if they're exactly the same in all other respects. But if one of these governments has an annual budget of $1 billion and the other one has an annual budget of $1 million, $1 billion versus $1 million, well, obviously a $13.5 million unfunded OPEB liability is a much bigger deal to a government with a $1 million budget than one with a $1 billion budget. And so having this ratio that compares the liability with the total payroll of the government, gives you a sense of how big a deal it is. So for that $1 billion budgeted government, this percentage would be much smaller than it would be for the government that has just a $1 million annual budget. One of the key factors that determines the funded status is the contribution effort of the government. And so governments are required to disclose information that compares their actual contributions with the annual OPEB cost. And that gives you a sense of whether they're keeping pace with the funding requirements of the plan.